So inflation index bonds are a kind of bonds in which your returns are equal to the inflation rate plus some extra return over it. Okay, and these were launched. These bonds were launched by the RBI in the June of 2013. Okay, and the point of launching these bonds uh, were to protect uh, retail investors against inflation. Okay, because there are a lot of people who invest only for the purpose of beating the inflation. Okay, and when that is your main goal, then you look for stability rather than high risk. Okay, you try to avoid risk and you try to look for stability. Now, even in today's time, regular bonds cannot beat inflation easily. Okay, and bank interest is very low. So so the best option were indexed inflation indexed bonds. Okay, because here the exact inflation rate will be the returns you will get plus some extra returns over it. Okay, so that is a good way to protect yourself against inflation, but unfortunately these were discontinued by RBI. Okay, the reason being, one of the reason was lack of awareness. At that time people were not very much aware, they were not understanding these bonds properly. Okay, the other reason for discontinuing was 10 years maturity rate. So because of this long term 10 years, people were discouraged to invest in this bond. Okay, so there was low liquidity in these bonds and hence they were discontinued by RBI. Now in today's time, uh, you can invest in pension funds and you can invest in uh, tax saving funds. Okay, which can save you against inflation. Okay, but there was a time when there was a bond which can directly protect you against inflation because it was providing you the exact returns, maybe a little bit more returns as comparison to inflation. Okay, with stability, because these are bonds, there was stability, and that was your inflation indexed bonds.